You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Tom, good to be with you. It's been an interesting time in the marketplace.
People are wondering if the rebound in the equity markets is the real deal, or is it just setting you up for more losses?
Oh, wow. Yeah. Well, let's review our work where we figured things would rally up until May. We thought maybe once the Shanghai market exploded, then, well, we didn't call for an explosion there, but once it shot up, then it replicated its top in 2007, and we thought that high could be in June, which it was. So our work in May was that you had the Dow Jones sell theory, and we waved the flag and said perhaps that's the end of the bull market, and you needed other things then to determine if a bear market was underway. And the latest failure, well, it was a few months ago when it took out let's use the S&P, took out the 50-week moving average, similar to 2007. So that got our attention. Then the next support, the support level would be at the hit down into August and September with the first discovery of serious problems in Shanghai. And the S&P bounced off of that. But important indexes such as the banks and the broker-dealers indexes on the financial side, where the party has been, they took out the closing prices of August and September, which was an alert, sort of a heads up. And then they rebounded, and then the next decline they took out, but the back to 2014, the October hit, that one was a pretty good support level, or at least it should have been. But, you know, we go back to that Dow theory, which we were using from April on, and it was not confirming the bull move in the transfers. We're not confirming the bull move in the industrials or in the S&P. And then it was one of the early ones that failed and taking out the August-September low. And then shortly after that took out the October low, from which we said, hey, this then looks like a bear market. And the senior indexes would then get in line, which they did do. And then all of a sudden, you know, it was like, get me out of here, and some pretty heavy-duty selling, which using the S&P brought it down to oversold and within a pattern which we call a sequential buy. So using some other work, we look for a pretty good rebound. One of the models suggested 8 days, but hey, let's be flexible on that, maybe a few weeks. And the other one model is a maximum rally of 38, Fibonacci number, 38% of what it gave up on the way down, which we're at that now, and we'll soon be at the 2-week level. So it really has gone straight up, beginning to get overbought. So it met the pattern for a revival bounce in here. And I think that's all there is on it, because you've had part of the failure and the big hit in the first of the year was that credit spreads started to widen again. I think it was December 22nd when you had the second breakout in spread widening. And if we go back to last summer, the second breakout in credit spread widening might have occurred in late July, but it occurred the first week in August, which is close enough. And we've felt all the way along that that's what really pushed off the selling in Shanghai. So there are some softening economic numbers. I think the U.S. auto sales peaked in October and have jigged down a bit, but the headlines, I think it was for the November, or maybe it was it would have been for the November number, was that, the sales are up to 15 million or something like that, so it was a great year. But they overlooked pointing out that the peak was in October and it came down a bit. So that's where that speculation and buying cars on the Never Never, both new cars and second-hand cars, is the equivalent of the action that was going on in the house market right up to 2006. All done on the Never Never, and somewhere reconciliation comes in, and they've got to reconcile all these obligations. So it's going to be interesting. Now, the other part was that of course, the weakness in global markets is tied to the weakness in crude oil. And it became oversold and ready for a bounce. Also, if we go back to September, we were then looking for a seasonal slide down into, December, maybe into January, like in previous years. So you got a bounce out of crude oil, and it could be stable for a little while, maybe into February, but the financial problems are getting serious. Some serious writers are recognizing that the recipe of central banks lowering interest rates isn't even driving much speculation anymore. And then some of them are talking about negative rates, and there's a huge amount of debt, sovereign debt out there that was issued at a negative interest rate. So this is really bizarre. People are holding cash because they don't want to get burned in risk, and term risk, or in credit risk. And so it's not going into industry. That's the old formula is to lower interest rates and provide lots of credit, and it'll drive a business recovery. But that's not happening. It drove speculation in lower grade bonds, which were funding speculation in cars, used and new. And you had a tremendous speculation in stock markets around the world, and all of those things look like they're rolling over.
Japan has just brought in negative interest rates. How's that going to affect the nation that probably has the highest savings rate in the world?
I don't know. I think, Jim, what it shows is that the policymakers have a theory, and it's becoming evident that it's not working, and yet they keep applying the theory. They keep applying it, and that, I think someone described that as fanaticism. When you keep doing something expecting a certain result and it doesn't happen, and you won't quit. So anyways, we'll see what happens with it.
Bob, we have a question from Willem in the Netherlands. He says, I noticed that since about late October, the U.S. 3-month T-bill has gone up from about half a basis point to about 30 basis points. I know that in bad times, the T-bill rate on T-bills is supposed to go down instead of going up, like it has in the past 3 months. Can Mr. Hoye provide an explanation for the rising short-term rates, and are investors still too complacent and not aware of possible nasty drops in the stock markets?
Yeah, well, that's a very good question. Is that let's call it in normal financial bubbles, the stock market goes up and spreads widen, and the demand for speculative funds drives short rates up relative to long rates, and then one of the signals that the speculation is fading is that short market rates of interest, like T-bills, that rate starts to come down. And go back to 1929. In April, May of 1929, market rates of interest, short-dated, started down, which was indicating that the intensity of speculation was getting tired. So, but this one, it's all backwards. They pushed the short rate down so far, which they can't push down forever. And it's worth noting that interest rates for long treasuries have been rising since February. And before that, you had the rates for junk been rising since June of 2014. So it's not as if the Fed was driving overall interest rates. So at any rate, you got this, it's backwards, Willem, and we'll watch and see what it begins. What it starts here. I've been watching commercial paper rates to see if it was independent, but not enough for us to make any conclusions there. I think we just have to focus on the low-grade rates. Junk bond rates are rising, and spreads are widening, and that is not a good picture. Gold, from time to time, has gone opposite. You have a down day in the financial markets. You can have an up day in gold in U.S. dollar terms. But we don't expect any huge moves one way or the other for gold in U.S. dollar terms. You have a number of years of stability for the U.S. dollar, perhaps firm relative to most currencies and perhaps firm relative to most commodities. And it's a confusion to the gold bugs who always figure the Fed is evil, the dollar's going to go down, and gold is going to go to $10,000. But we don't see that. The real price of gold has been going up, and that's making the operating margins for the gold industry better, but it has yet to hook up and become part of the equation when looking at gold shares. But, a few months ago we bought a few gold shares at low, and then a week or so ago wrote that you could, on the next opportunity of weakness in gold shares, could accumulate a little more. So we'll stay with that position.
Willem also asks, are investors running out of cash, or are investors still chasing yields in the U.S. Treasury market?
I think it's both is going on, to answer Willem's question, because it depends. Not every actor in the play is doing the same thing, and some people are still leveraged, other people are trying to save money, and other people are trying to figure out why they'd want to save money. But I think the tone of the financial markets is precarious. I think this rebound is just about worked itself out, and it'll be interesting to see what happens on the next rollover.
Bob, we had a study done in Canada saying $75 billion in private hands has been pulled out and is just sitting on the shelf looking for a good investment. I wonder, what about these new e-banks that are showing up, Tangerine, EQ, where they offer 2.5%-3% in their savings accounts? Are these the new trend?
Oh, I would be. I think in a wild financial world such as we are, there's always new items, new games. Even it started in the South Sea bubble in 1720, where there were new financial instruments created. The imagination of financial people is without limit. So, to me, these new items, if you're getting an extraordinary or a better yield than otherwise, you're paying for risk, and the risk can eventually bite you. So I'm not going to comment on that, a lot of these new things, because in previous financial bubbles, you have a huge expansion in the normal instruments of credit. You also have, as I said, since 1720, the first one, the innovated forms of credit instruments, all kinds of new stuff. Well, of course, nowadays with computers, the last 20 years, the imagination has been without limit. And so in a contraction, the normal instruments of credit contract, and, of course, the abnormal, the innovative, all the new stuff just turns into garbage, and as they said in 2009, all of that stuff turned into toxic waste. And there'll be some of that around this time.
Of course, what about depositors' insurance, or is that not worth anything anymore either?
Oh, deposit insurance? Oh, that's a game. There should be no such thing as in deposit insurance forced by the state, because the market should be able to figure out which banks are worthwhile and which one you should put a deposit in. And the deposit insurance, going back to the savings and loans in the U.S., allowed all kinds of reckless banking. And in Canada, deposit insurance is assisting people to be reckless at a time when it's never wise to have reckless banking at any time.
Bob, thanks a lot for chatting with us today.
Jim, always good, and we'll look forward to talking to you next week.
My guest has been market historian Bob Hoye. He's the Chief Investment Strategist for InstitutionalAdvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. You can forward questions for Bob or comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.